Hey, good afternoon, everyone, or good evening, or good morning. We have members all over the world. Wherever you're at, it's great to have you with us, joining us today. It's July 13th, 2020. It's our Q2 earnings sneak preview webinar. Those of you who are new to Earnings Beats, want to take this opportunity to welcome you. Thanks for giving us a try. Of course, thanks very much to our seasoned veterans as well. You all help make up the successful Earnings Beats community. A couple of quick things and we'll get started. Number one, of course, all of our events are recorded. It'll show up on the site. You'll be able to check it out. We'll make sure everybody gets a copy of the webinar as well. And this particular event was one we started, a while back. And what this event about is giving you a sneak preview to the main event, which is next Monday, the 20th of July. By then, a number of companies will have reported their earnings, and that week will be a week when things really kick into high gear. So today is just an opportunity to give you an idea of what will be covered. Today is a public, open to all Earnings Beats community members, no matter if you're a subscriber or if you are an Earnings Beats Digest member or just stopping in. Next week requires a membership. It can be a trial membership, a full membership, but you do have to be a member because a lot gets covered, a lot of important information ahead of earnings that could be, very valuable. So I want to make sure you know about that. We've also got an event coming up tomorrow that I think is going to be quite timely. It's our Max Pain webinar, where we talk about what stocks and indexes might move in what direction based on options expiration Friday. I think we might have seen a little sneak preview of that today as well. Anyways, a lot of events coming up, and want to hopefully, if you're not already a member, you'll sign up for a trial and join us. Anyways, I know people are here for the main event. Let me see if Mr. Bowley's around. You there, Tom?
I'm right here. How you doing?
Well, if you hadn't told me it was options expiration week, I might have guessed.
Yeah, quite a reversal today.
That was quite a reversal today. And, we've talked about this how many times, right? Last week we were talking about how many stocks had the put-call ratio, how it had really been on the low end of things. And so this is not totally surprising. So tomorrow's event should be very interesting. I'm really looking forward to it.
Yeah, it should be pretty timely. I've been nervous. I mean, I'm very bullish, but short term, I get a little nervous when everyone gets so bullish along with us. And that's really been the case, especially in the options world, which makes tomorrow's Max Pain event pretty timely. I kind of wish everything had held off for another day or two on the reversal.
Yep.
Just because, Max Pain would have pointed out tremendous net in the money call premium value, not just across, one stock or one industry group. I mean, really across a lot of areas of the market. But some of that was taken care of today. There's still plenty to go, believe me, potentially.
Yeah.
Yeah, there was a big reversal today for sure.
Maybe even to the point if we get a lot of follow through selling in the morning, we might be looking at, some stocks or indexes that might be able to gain as well. So it's going to be interesting. I do want to mention, just while I have you here, and while I'm here for just another 30 seconds, that I want to mention to anybody who's either new or a monthly member, if you go to the website, you will see that we have a webinar special. We do this for every webinar, and it allows you to save a lot of money by signing up for an annual membership. So just go to earningsbeats.com. you'll see the webinar special and save yourself a lot of, there you go. Tom's got it right there. It gets you into the events we have coming up. There's a lot of them, like I said, coming up, and everything we have to offer, which is just tremendous. It's tremendous value. You cut your costs in half. I highly recommend this to people who are trial members now if you want to save a lot of money. And then if you're just visiting us for the first time, you can sign up for a no-cost trial for 30 days. We charge you $7 and you get the $7 back quickly and you'll be all set. So I'm going to get that out of the way, Tom, and I'm going to turn it over to you, my friend.
All right, sounds good. We'll get started here in just a second. I think first what we'll do is go through today's agenda. Got a few things that we want to cover tonight. I mean, this is kind of typical for what we do in terms of these sneak previews. But we already kind of went through an introduction, so I won't spend too much time there. I wasn't planning to do a market update, but just with everything that happened today, I think it would probably be a good idea to maybe just take a look at a couple of things, give you a brief market update, and then we're going to go into recent earnings, both positive and then negative. Show you a little bit. I want you to look at the charts because it's really important. If you're holding stocks or you're wondering, you know, should I hold this stock into its earnings report? Should I not? Should I sell half? Maybe, you know, maybe you're thinking about, hey, should I buy a stock right before earnings? I think if you use relative strength, you'll get better clues. You're never going to get 100%. I mean, if you're looking for a guarantee by looking at a chart, that'll never happen. I've been in this for a long time. I have seen some of the best, absolute best charts going into earnings reports, and then they just absolutely lay an egg. And essentially, I don't know exactly what the discussions were when management met with Wall Street, but they probably sugarcoated some of their, you know, what was going on. And then they come out and they lay an egg. And I can tell you, Wall Street doesn't forget those kinds of things. That's why it behooves most of these companies to report strong numbers. But anyway, we'll go through and we'll take a look at some of those charts. And then we'll get into some upcoming earnings. That'll be, we're going to be looking at really as we go throughout this week. Earnings season is beginning to kick in. Not a lot of earnings reports this week, but many big earnings reports. Usually you get the big companies reporting first. So we're going to get a lot of the big banks this week, a couple of really big transports. We got Netflix reporting this week. So we've got some pretty exciting stuff that we're going to take a look at in terms of potential earnings reports out later this week and what their charts are telling us. So all of that is what we're going to go over. As John mentioned, next Monday we'll kind of extend this. Right now we're looking at what's going to happen this week. The next week is going to be really big because we're going to basically look at some of the best companies in terms of earnings reports coming up throughout earnings season, not just for the next week, but really for the next several weeks. And try and point out some of those that look like they're going to have blowout earnings, others that I would simply stay away from. So that event will be next Monday. All right, let's go ahead and jump in and take a look at what happened today. Because it was a reversal, and it was when I was publishing our daily market report to our members today, it was probably about 2 or 2:15. And I want to show you where we were. So this is a chart of the S&P 500. I'll come back to this, but let me just show you on a 10-minute, 5-day chart. So I was getting ready to publish right around 2 o'clock. I may have published at 2:10, 2:15, but I had literally just posted to members that this high at 32.35, if we go back to that daily chart, we were sitting right up here ready to potentially make a breakout. And we've had all of these warning signs that have been in play here for really at least the last few days. I might even go back a little bit longer than that with some of the negative divergences showing up on 60-minute charts. The sentiment, there's been so much bullish sentiment. We've seen the VIX rising, even though the market's been rising. I mean, there's just a number of things that have said, hey, you might want to be a little careful, or at least be aware. You know, this isn't the kind of market that you just want to jump all in and then just go away and not pay any attention, because you could see major differences when you get back. And that's exactly what happened today in the last hour and a half to 2 hours. I mean, it was just a major reversal. So at 2 o'clock or just before 2 o'clock, I think around 1:30, we were at a high, clearing that June 8th high on the S&P 500. That was a pretty big deal if we could make it. But we didn't make it. We had a big reversal, and off this uptrend, that's actually a reversing candle. That's a dark cloud candle. I wouldn't be surprised to see some more selling off of this. The other thing we have to keep in mind too is that July 17th is right around the corner. And while a lot of folks point out, go away in May, I've been following history for the last 70 years. Don't go away in May. May and June are not that bad, actually, even through the first half of July. But the true go away period is July 17th to September 27th. I mean, if you told me I had to go away for a period of at least a couple of months, it wouldn't be May 1st to October 31st. I can promise you that. It would be July 17th to September 27th. That historically, I have the facts, I've got the numbers. That's when you want to be more careful in the market. And to me, it makes sense. A lot of folks go on vacation, so it's less volume. I think it's much more easily to manipulate with less volume. And I think that's just what happens. I also think once you get into September, you can't just keep saying the same old thing. After the first quarter of the year, after March quarter, you say, well, we missed those numbers, but the second quarter is going to be great. You get through June, you say, well, first half of the year wasn't quite what we thought, but we're really looking forward to the second half of the year. Well, by the time you roll around to September, your year is pretty much cooked. And I think a lot of companies, if they know they're not going to hit, if they're not going to beat their numbers, a lot of companies will just simply throw everything at the market. They're just like, okay, let's just throw in the kitchen sink. I mean, anything that's bad, let's just bring it out now. And so I do think September, which historically has been the worst month for the market, I think that's the month where companies just finally throw their hands up. If they're not having a good year, rather than just sugarcoating it anymore, they just say, okay, let's just throw all the bad stuff in, tell everybody we're not going to do it, and then move on. And so the market tends to bottom at the end of September and tends to do really well through the mid part of January. So always remember that July 17th to September 27th period. So it's about 2 months, 10 days, something like that. And I've had folks write into me and they say, well, you said that's the really bearish period. Should we just sell everything on July 17th and not have anything? My answer to that is no. First of all, historical tendencies is not really what I trade off of. I mean, yes, it's good to know. It's a nice indicator. If the market looked really weak going into July 17th, if technically I didn't like what I was seeing, there's negative divergences everywhere, the wrong groups are leading the market, then I would say, yeah, that'd probably be a great strategy. But just because the tendency is for the market to move lower doesn't mean we move lower every year. If the market looks good technically, I would not just say, hey, it's July 17th, let's get out. The market will go up during the summer when things are bright, when technically we look good. So keep that in mind. It's not a one size fits all every year, just get out of the market on July 17th. But it's worth knowing. Definitely is worth knowing historically that July 17th does mark the beginning of a historically not so great period. All right, so looking at the market, again, there's your big reversal there. Failure, you had the breakout. We were there. 32.32 is the breakout level on a closing basis. We hit 32.35 today, got 3 points above it. If the S&P 500 was going to reverse, that was the level. And sure enough, again, going back to that 10-minute, 5-day chart, there's your reversal. Coming right back down, lots of sellers. I can promise you, I can't promise you, I don't know for sure, but my gut feeling is that you saw market makers beginning to sell a lot of stocks at the top. And once they started selling, it just led to more selling, which led to more selling. That's how the market moves when it's selling off. All right, so the S&P 500 obviously is a little bit of a problem. Let's take a look at the NASDAQ 100. This has been the strength. I mean, there's no doubt the NASDAQ has been the strength. You do have to be careful, though, when you see these big red bearish engulfing candles. Look at the volume pickup. This was the heaviest volume we've seen probably about the last 2.5 weeks. And it accompanied a very bearish candle where we were breaking out at the open. We were up over 11,000. First time ever on the NASDAQ 100, above 11,000. We closed back down 500 points. We reached 500 points below that high. We actually closed 467 points off of that earlier high. I'd call that a reversal. And when it's done on big volume, I think in the near term, you got to be careful. If you look at the last couple of times that it's happened, you know, this one right here wasn't that big. This one was, though. We went up about 5-6 days in a row, big reversing candle. Next 2 days, we were down to the 20-day moving average. So didn't spark a huge sell-off where, you know, everybody's running for the hills, but it did create, I don't know, we were probably at about 9,100, fell back to about 8,850. So that's 250 points, another 2-3%. I mean, if we did that again, we'd easily be back to the 20-day moving average. And that also is where we broke out from, 10,250. That's 350 points from where we closed today. 350 points is about 3.5%. So wouldn't be surprised over the next few days to see the NASDAQ 100 pull back and test that 20-day moving average. Now, if we close below it, it would be the first time since back in early April. So does that mean we'd be going back down to the bottom in March? No, I don't believe that at all. But what it could mean is we could come back down and test these other lows, maybe that 50-day moving average. I mean, that would be another 800 or 900 points from where we are. That would be quite a bit of room to cover to the downside. So I just wanted to point it out because I do think when you see these big reversals, you can see one here. Of course, back then we were already in a downtrend and below the 20-day. In this case, we're in an uptrend and above the 20-day. So it's not the same there, but it is similar to what we saw back in January. Had a nice move up, just kept going up, 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 big reversal. Next day we gapped down and we're all the way back down to the 20-day. So I do think the 20-day is probably going to come into play. I'd be surprised if we don't see some more weakness after all of that selling, closing on the low. I would think we've got some more weakness in the near term. Now, why was I cautious? Or, you know, I kept writing, I almost felt like a broken record, but I kept writing to our members in the daily market report saying, hey, I'm cautious, negative divergence. Hey, I'm cautious, sentiment. I'm cautious, you know, I even said on Friday, we started seeing that rotation shift back from the strong pandemic stocks to the weak pandemic stocks. And I expected that would continue. When I sent out the DMR at about 2 o'clock, it was kind of continuing a little bit, but not that much. Well, it continued a lot after the DMR went out because most of the selling was in those strong pandemic stocks. I haven't looked or calculated, but I know our portfolios, which have been absolutely on fire, definitely took a pause today. And the aggressive portfolio, I think, got hit pretty good, maybe as much as 5%. So it was a big reversal today, no doubt, definitely a shift. And I think we have to anticipate that that same shift is likely to take place. I'm going to go back one more time to the S&P just to show you that from mid-May to that June 8th high right in here, that's when those weak pandemic stocks were leading right there. And if you pull up the NDX, we went up during that period, but on a percentage basis, we actually took a back seat to the S&P 500 during this period. But from June 8th all the way through, you know, today's high, you can see we were way, way higher on the NASDAQ 100. On the S&P 500 from June 8th, we were just barely getting back. We were just testing that high. So the last month, we have seen tremendous outperformance by those the strong pandemic stocks. So can't go up every day. I mean, I actually think the next few days we could see some additional rotation, allowing some of those other weak pandemic stocks to continue to outperform. I wouldn't be surprised. All right, let's move on to sentiment. So sentiment within this market update, this is one of the reasons why I was really nervous. When you look at the market, this top panel up here is the 5-day moving average of the equity only put call ratio. When you see low numbers, when this 5-day moving average moves below 0.55, it's telling you that an inordinate amount of calls are being bought relative to puts. If you're buying calls, equity calls, you are convinced the market's going higher. If you're buying equity puts, you think the market's going lower. What I can tell you is that if you notice when we get high readings, this is when the market's very fearful. This is telling us that retail traders are buying a lot of puts. They think the market can only go down. When you see these high readings spike, that marks bottoms in the market. Look at the S&P bottoming. When everybody's buying puts, thinking we're going to go down, we bottom. Here, think we're going to keep going down, right? We bottom. Come over here. Another high reading. We bottom. Another high reading. We bottom. These two high readings, in both cases, we bottom. Now, they were short-term bottoms. I mean, in some cases, I mean, we kept going higher. But what you're looking for is this is more of a short-term trader kind of a chart. Because when you see extremes, you've got to be nervous that the market's going to reverse. So those tops in the CPCE generally mark bottoms in the S&P 500. Well, when you get overly bullish and you've got everybody buying calls hand over fist, you've got to be careful that the market's going to top. And so when you look at some of these very low readings where all the calls are being bought, you're going to see, you know, right in here, big top. Here we went below, big top. Here, not so much. We went sideways, didn't really sell off. Here, we topped. Here, we topped. Now, again, many of these are just short-term pullbacks, but if you're a short-term trader, pretty important stuff to realize. So this is why I've been nervous, because this 5-day moving average has moved below 0.45, and it's only the second time it's done it throughout this bull market. That's, you know, and the last time it did it, you can see we topped. Did we sell off? Was it the start of another big leg down? No, but we sold off. If you got profits and you see everybody jumping in on the call side, you might either want to take profits, maybe take partial profits, maybe buy put options, you know, either against your stock or against the market in general, just to provide you some kind of a hedge, some cushion. And that's what these charts are telling me. So, you know, if you've been getting the DMR and you're like, why is he, you know, so cautious? What is he talking about? This is what I'm talking about. Now, another chart here, and this is the last one, then we'll start looking at some individual stocks. But here, the volatility index. Now, the volatility index is based off of, it's calculated off of short-term S&P premiums, option premiums. So anytime the market gets more fearful, that's when you start seeing these big swings in the market. And that's when pricing of options become more expensive. If the market's not volatile, if we're just going up, if the Dow's just going up 20 one day, 40 the next, down 5, up 7, up 60, that is a very boring market. And when you get into a market like that, premiums on options go down because there's not much volatility. You're not going to be willing to pay a lot of premium for an option if the market's not moving. The market moves when the market drops. That's when it really gets going. I mean, you can see here. Look at that big drop. When you get the big drop, you can see volatility shoot through the roof. Big drop, volatility's up. Big drop, volatility's up. Look at this. Very boring. 2017 was the least volatile year, I believe, from what I recall, in history. And I remember it set a record for the number of consecutive days it went up without a 3% pullback on the S&P 500. I mean, look at what we did today on the S&P 500, 32, 35. And we came down probably 2.5% in the last 2 hours. We went, I want to say, like 400 or 500 days in a row without a 3% pullback. I'm not talking about 3% on one day. I'm talking about there was never a cumulative 3% pullback off the highs. So here you can see the VIX goes down to single digits. Very, very boring. You're not going to pay much for options. You're not going to have to pay a whole lot in terms of premium. Why? Because the market's not moving. It's just this slow, steady, boring push to the upside, which, by the way, I like slow, steady, and boring to the upside. I prefer that over this. But this is what we've got. This is what we got to deal with. So anyway, the VIX is very elevated. I mean, when you look back at the 5-day moving average, anytime the VIX is above 20, in my view, and rising, you've got to be careful. I mean, even if it's below 20, you know, or even if it's above 20 and coming down, you got to be careful because it can reverse. But I just think it's really important that when the VIX is high and we're getting a lot of people buying calls, those are two sentiment indicators that are telling us we've got to be careful. So just, you know, keep that in mind not just now, but also in the future. These are a couple important charts. All right. Okay, so that's it for the market update. I went a little longer than I wanted to, but I did want to point out because we had such a big reversal today. Let's go into the recent positive earnings. Actually, no, let me take that back. Let's go into, yeah, recent positive earnings. That's what I wanted to do here. So bear with me one second. All right, I'm going to start. Oh, and by the way, I'm sorry. I want to move back for just one more thing, because if you want to know where you can go for the option information, go over to CBOE. One thing you can do is if you click on, where was it? I think it was in the markets. Maybe US options. I'm trying to think how I get into this. I was just there. Oh, maybe it's market statistics. I wanted to show you there's a place where we can go and get half hour. And I know it's in here somewhere. Let me find it. No.
Hey, Tom.
Yeah.
I know when I go to cbo.com, I go to the delayed quotes. I'm not seeing it in this particular.
Yeah, let me try this again. Maybe it took me to a different page.
There it is, quotes
yeah,
and data.
quotes and data.
Yep.
Okay. Yep. I knew it was here. I just I don't know why it took me to that page. But anyway, when you go into cboe.com under quotes and data, here over under intraday volume, if you click on this, it'll bring you the total calls and puts every half hour, and it gives you the put call ratio, but that includes index options. I ignore index options, and the reason is index options are traded a lot by professionals. They're used as hedges. They're not gambling. You know, they're actually using a lot of index options to hedge and lower risk. What equity options are, these are much more driven by retail traders. And so you got a lot of retail traders who trade options. And I don't have to tell you, hey, there's some really good options traders out there. I'm not going to say everybody who trades options is wrong, but I can tell you the professionals tend to go against the herd. And so here, when you're looking at the equity options, we have the calls and the puts. Well, you can see the puts here are less than half of the calls. So that's 1, that's 2, 1/3. So that first reading, and actually, I think I did a calculation of this earlier. Let me see if I can pull this up. Yeah, actually, I had, it's just under 1/2. So it was 0.45. So this, if you take puts and divide them, the equity puts divided by the calls, you come up with 0.45. And then I did it by every half hour all the way through the close. Well, I did it through 1:30 because I was doing this right before I sent out the DMR. So I didn't update it by the end of the day. But this is where you get the information on the equity puts divided by the equity calls. And over at stock charts, you get it by the CPCE. That's the $ CPCE. So I think if we just pull this up as 1 day, should come up to, well, it's coming up today. Actually, no, that's still, it doesn't have today's data. That's July 10th. So that was Friday, 0.46. So it's not matching up just yet. It will. I imagine it probably updates. Maybe it'll update at 5 o'clock or a little after. I don't know. Anyway, I just wanted to show you where you could get that data. So let's move back over, and now we'll jump into the, see if I can find it. We'll move into the recent earnings that have been positive. So let's start with Zoom. And by the way, a lot of these stocks are some of the best performers. in terms of relative strength. And many of these stocks got hit very hard today. So you're going to see a number of these, like Zoom today was down 15 bucks. When I say that the strong pandemic stocks didn't do well today and the weak pandemic stocks did, or at least did on a relative basis, did better. When I talk about strong pandemic stocks, this is what I'm talking about. Stocks like Zoom that have been going up since March, even throughout the pandemic, setting new highs. Now, not all of them were this good. I would say Zoom has been one of the best stocks in the market. All right, so there you've got Zoom. Let's keep moving. I'm not going to spend too much time on each individual chart, but what I do like is I like to look at Zoom or any of these stocks relative to their peers and relative to the S&P 500. So when we're talking about relative strength, you can look at the scooter, or you can also look at these price relative charts. And this is the way I like to set my charts up. So I've got not only the price action I can watch and what's going on, but also I can watch these relative charts. Because if I'm trying to outperform the S&P 500, I need stocks that are outperforming the S&P 500. I'm not trying to time a bottom. I'm not a value investor. So got to, at least be aware. I just want to make sure everyone understands the perspective here. All right, let's move on. Next one. NVIDIA. Same thing. Big move up, big reversal, but look at the relative strength. When you've got a chart that is showing everything under, this is the industry group absolute chart. So you start off, you got NVIDIA going up. Then you've got its peer group semiconductors going up. Then you've got NVIDIA going up relative to semiconductors. Then you've got NVIDIA going up relative to the S&P. And then you've got semiconductors going up relative to the S&P. That configuration, if you get stocks in your account that look like this, you're going to, in my opinion, you're going to do a lot better over time. Now, of course, you got to decide how much room you want to give. Some of these stocks will roll over and eventually they'll lose their relative strength. But you can see that the relative strength here started, this downtrend got broken back in late March. And it's been trending higher for the last 3 months. All of these lines have been trending higher for 3 months. NVIDIA was 275. Now it's 400. It's been a leader. This is how you outperform. And it's one of our portfolio stocks. All right, DocuSign. Again, just going to show you the charts. Just look at this. This is beautiful. Yes, it pulled back today. Yes, it potentially has more downside in the near term, but I think it's still a great looking stock. Datadog, same thing. I think you're going to kind of get the idea as we go through these charts. And again, many of these are in software, by the way. Software took a big hit today. Zscaler, big move up, software. And you can see all the relative strength there. So if you're going to get a software stock, you just want to make sure you're sticking with leaders. All right, SPWH, this is Sportsman's Warehouse. So got something a little different, specialty retailer. But if you didn't know the left side of the chart, if you didn't know the name of the company, and you didn't know the group, you might still think it was software. Look at this, beautiful move up, great relative strength, great absolute strength, just a really good looking chart. Lakeland Industries, all right, this is in clothing and accessories. Now we had a big gap up, pulled back, and then came back up and broke out. And you can see relative strength near a 50, actually looks like hit a 52-week high last week, maybe toward the end of last week. So we set that 52-week high, but then we pulled back off of it. The group though, see the difference? And this is why maybe I would tend to be careful or maybe make sure I keep my stops a little tighter on a stock like this, because clothing and accessories has not been a great area relative to the S&P 500. So got to keep that definitely in mind there. All right, let's keep moving here. How about next one, Coupa software. Many of these charts looking the same. See that big drop today? Software took a big hit, but the overall strength continues. So if you're sitting in cash, you should welcome some of the selling in some of these stocks. CrowdStrike Holdings, CRWD, big move up. Once again, software. Software has been one of the best areas. So if you're looking for some of the best relative strength stocks, you're going to see software. Just no avoiding it. BJ's, now we've got something a little different, another specialty retailer, but BJ's breaking out. And the relative strength, for the most part, going up. All right. Next up is SNPS. This is Synopsys. Another software, another move up, relative strength going up across the chart there. The Lovesac company, this is a furnishings company. And this one started to roll over, got its first close below the 20-day. I think there's a decent chance this one goes back to the 50-day. And actually, if it does, it should run into pretty good support down around $20. So keep an eye on the Lovesac here down. If it continues to pull back, I think the 50-day could present pretty decent opportunity. Relative to furnishings, it's been awesome, but look at furnishings relative to the S&P 500. This is the problem. You're just not in a great group right now. But Love, L-O-V-E, has been one of the best stocks within that group. VIP Shop, another broadline retail. Well, actually, this is the first broadline retailer I think I've shown you. But VIP Shop, you can see very strong. Broadline retail has been strong. VIP's, been maybe just going along for the ride with its peers the last 6 months, but that follows an uptrend. And you can see the last 6, 7 weeks, seems like we've been uptrending again. Versus the S&P, it's breaking out. And this is really the key. I want to make sure I've got stocks that are beating the S&P 500. And there you can see broadline retail performing very well versus the S&P. Next up, VEEV Systems, VEEV. Another software stock, big move up. There's your relative strength. OLLI's, now this is a broadline retailer. This is one I wrote about breaking out with a lot of short interest in my blog. I think I probably wrote about this right around in here. So middle of May, second week of May sometime. But not only was it breaking out, not only was it showing relative strength, well, here it was showing broadline retailers were going up. Here's where it was showing relative strength. But it also started clearing some pretty important resistance levels. And so that stock just continued to go, but rough day today. NetEase, NTES, big gap up here, starting to pull back a little bit. This is one of the stronger internet stocks. Hopefully you're seeing a pattern here of a lot of the things we like to look for though. These stocks, by the way, are all on our strong earnings chart list. We have 325 companies on there right now. I will be taking a bunch of them off though, because as we move into earnings season, a lot of these companies are going to be reporting. So we take them off of our strong earnings chart list as they're reporting or just getting ready to report. So we will be cutting back on this strong earnings chart list quite a bit here over the next couple of days. But over the next few weeks, as these new earnings come out, we'll be building the list right back up again. Spartan Nash, SPTN, nice move up. Good volume here on this earnings breakout. And I think it's just a matter of time before this one breaks out. But this is in the food area. So it's more of a defensive play. So if all those software stocks don't appeal to you, maybe a stock like this would. It is outperforming the S&P. It's outperforming its peers. But because it's in the consumer staples area, it's not been a great area versus the S&P 500. So, it's not going to be a fast mover. Probably not. So, it's not one of those highly volatile stocks. So it might just be one that you like that's a little less volatile. OKTA, this is another software. And once again, you can see the relative strength going across. But rough day today, closing below the 20-day moving average and doing it with pretty heavy volume. So it looks like next stop might be a 50-day test down around 190. DOMO, another software. But once again, and by the way, not all the software stocks look like this. I'm giving you the ones that have reported strong earnings in the past and look good, technically. Alibaba, broadline retailer. This one actually went sideways for a while, and I think I mentioned this one. I don't remember if it was on a show, if it was in the daily market report. I can't recall, but I remember talking about it when it was making the breakout, or maybe as it was approaching the breakout. But it has made a huge move, pulling back. Should have great support though in the 225 to 235 area. So if we keep seeing a sell-off here, that would be a pretty good sign. Now, Alibaba relative to the broadline retailers has been moving lower. So it's still outperforming the S&P. Why? Because the broadline retailers are killing the S&P. So even though it's not one of the best broadline retailers, it's still able to outperform. But I like this volume in the breakout. I think the relative strength, this could just be starting to the upside, given the volume and given this breakout. Big Lots, BIG, another broadline retailer. I think you can see some of the themes, and this is why, you know, we focus on broadline retailers, specialty retailers, software. I mean, these are the companies that have been leading the market. Unfortunately, when the pandemic stocks get hit, these are the ones that go down the hardest as well, and that's what we saw today. Autodesk, another software. Autodesk, maybe not one of the best software. You can see the last 30 days or so, it's been pulling back, but that's mostly because we've been consolidating sideways here. When we were moving up, you can see that the relative strength was very solid. All right, probably only have about another handful here, and then we'll move on to some of the stocks that have reported negative results lately. MRVL, this is one that I think looked pretty good. It's in the semiconductor area, and it broke out back here late May into early June, good volume trends, and you could also see the huge spike in relative strength back then. It continues to move up versus both semis and versus the S&P. I think the stock still looks good, but it had a rough day today. I'd watch that rising 20-day moving average. Elf Beauty, this is personal products. Been in a nice uptrend for a while here, holding above the 20-day moving average. Relative strength, as you can see, very, very strong. Thor Industries, THO. Now we're moving into recreational products. Stocks pulled back now for the last few weeks, but it's been during a period while recreational products have just simply consolidated. They have not been moving higher. So we have seen some weakness on a relative basis, but overall, you know, recreational products has been very strong versus the S&P. And if you look and go back a few months, I mean, if we're just looking the last 3 or 4 weeks, it looks weak. But the last 3 or 4 months, we've still got a really nice uptrend in play. So I wouldn't be surprised to see a reversal here. Maybe a little bit more consolidation, but I think this is a stock that has a chance to run back to that June high. Lowe's companies, a lot of sideways consolidation after this huge move to the upside. So it's a relative strength versus home improvement and versus the S&P. Very, very strong. Been a great company. All right, we just have 2 more. First, General Mills. This is going to be another conservative play. I'll be honest, I'm a little nervous about that candle. It looked like we had an easy breakout today, got the big reversal. So short term, we may pull back, but I'd watch that rising 20-day. I think the rising 20-day holds, and I think this is a stock that can go higher. Relative to the food products area, it's near a 52-week high, not far. Relative to the S&P, starting to turn back up again as well. Last one, this is Slack Technologies, and Slack looked like it had a big breakout. This is a stock that I own. I actually really like Slack. Was excited earlier today to see this breakout, and then look at that reversal. That does not bode well in the near term. Big volume reversal. Stock was up to 36.23 intraday and closed at 33.42. That's a big reversal off of a breakout. Failed breakout, big volume. Normally, that's going to mean at least a little bit more short-term pain. Now, work on a relative basis. See, work has been consolidating. It actually was breaking out, had really strong move going into earnings. It was actually one of the best performing software stocks heading into earnings, had this huge move. They beat top and bottom line, but it had run so much that the market pulled back anyway, and I think has been consolidating. I've been waiting for this breakout, and I really thought we had it this morning, but you can see that was a massive reversal off of that. So where does work go from here? I think probably the 20-day. If it doesn't hold, then I think you could be looking at that $30 again to the downside. Test one more time, see if that holds. All right, so those were the positive earnings that came out recently. I'm now going to move into the negative earnings, and I'm going to start with Walgreens Boots Alliance. Now, what you're going to see on these charts is polar opposite of what you just saw on all of the positive charts. All of those companies that reported didn't just start leading all of a sudden when their earnings came out last quarter. Most of those companies had been leading for many, many months. Well, now we're looking at a company, Walgreens. You can see, look at this move to the downside. Here was March. This is when the market bottomed. Since then, Walgreens has been moving sideways. I mean, literally where it closed today is actually slightly lower than where we were in mid-March. Now, we know where the market was in mid-March. I think it's pretty clear before we even look at relative strength, we know that Walgreens has been an underperformer. So when they went into their earnings just a few days ago, end of last week, I remember talking about this one. I'm pretty sure it was on my show, one of my shows. And I said, I would not be holding Walgreens going into earnings. And the reason being, look at the relative strength here. So you've got drug retailers, which have been, on an absolute basis, just been moving lower. Walgreens relative to its drug retail peers, down near a 52-week low. And if you look down at the bottom here, drug retail versus the S&P is at a 52-week low. So you've got one of the worst industry groups, and you got one of the worst stocks within that industry group. Do I want to hold that into earnings? No. I mean, I'm thinking when I look at this, the visual that it's painting for me is that this is a company that's going to miss, and they missed. I think they came up with, I don't remember what the exact number was, 82 cents, 83 cents, something like that. Actually, I might still have it. No, I don't see it here. I think they posted like 82 cent earnings, and the market was expecting like $1.05 or $1.03 or something like that. They came up short. But should we have been expecting anything else? I mean, seriously, look at the way this is trading. If Wall Street sends their analysts out to meet with the management and they get good news, they're going to come back and buy the stock. It's going to be a relative leader, not a relative laggard. So when if you're thinking about what to do with your company, a company that you own heading into earnings, or let's say, a company reports tomorrow and you're like, should I get into this right before earnings? I would absolutely be looking at these relative strength. This is going to give you the best clue. Again, as I said at the top of the show, you're not ever going to get, you're never going to get that guarantee, but you're going to get some good clues out of using relative strength. And that's really the purpose of this webinar tonight, and especially the one next Monday night. All right, some others that recently reported some dismal results. These are all companies that posted both revenues and earnings per share below expectations. And when they did so, Chico's, this was back in June. I mean, just look at the way the stock had been trading relative to the apparel retailers, continuing to go down, and look at apparel retailers relative to the S&P 500. Bad group, bad stock. What do you expect when they come out with earnings? Bad results. Guess. Another one, very similar looking chart. Moved up in June. This was when all those weak pandemic stocks were moving up, remember? Mid-May to mid-June. These were stocks that had been beaten down, and then all of a sudden money rotated, and Wall Street seemed to like all these stocks. Remember the airlines? Some of those airlines went crazy for about a month. They all went back down to where they were. Guess hasn't gone all the way back down, but it certainly has not been a very good performer. And again, you can just see these charts and these relative lines, they are not pointing up from left to right. They are pointing down from left to right. Don't want any part of that. Oxford Industries, clothing and accessories. Here's your May to June run. And look what's happened since. Same thing. So these are the companies, like I said, the rotation that took place on Friday and then took place again in the final couple hours today, that could continue here in the short term. So some of the high flyers might take a back seat short term, and we may see some of these other stocks show a little bit of strength for a period of time. It happened back in May and June. I don't think it's going to happen for 3 or 4 weeks, but I could see 3 or 4 days. We'll see. Dave & Buster's, play, again, same thing. Look at this, running right up to that June 8th and then back down again. So everything that was really bad back in March and April, couldn't catch a bid back then. Those are the ones that sold off after June 8th. Just couldn't go anywhere. And that's what's been holding back the S&P 500, by the way. That's why the NASDAQ's been killing the S&P 500. The S&P 500 is burdened with a lot more of these weak pandemic stocks. All right, so let's take a look. So this is in the restaurant group. What's restaurant doing versus the S&P? Not very good. If you want a good restaurant company, look at something like Wingstop or Chipotle. Both of those companies have been seriously outperforming their peer groups in restaurants, and also they've been outperforming the S&P 500. So if you can do that within a bad group, more power to you. But here you've got a play being one of the weaker stocks in restaurants, and we know restaurants haven't been very strong. Also, look at the volume, very heavy, coming back down. I don't know, I just don't like this one. And would not have been thinking about owning it into earnings, that's for sure. PVH, another clothing and accessories company. So you're already hopefully kind of seeing the types of stocks that were beating and moving higher and showing relative strength, and now the types of stocks that are missing and showing relative weakness. But PVH, same thing. Look at the relative weakness coming across here. Not good. AZZ, this is in, I think that's electrical components. DJUSEC. Yeah, electrical components and equipment index. But as you look at this chart, AZZ, look at the relative strength. Now, we started to see a little bit of strength in this group back at the end of May, early June, but just like all the other weak pandemic stocks rolled right over on a relative basis right about June 8th. And look what AZZ is doing. Going nowhere, been downtrending for many, many months. And so what happened when earnings came out? They missed. They missed their top line. They missed their bottom line. The stock fell from $33 down to 28 and change. And so again, these are the type stocks, in my opinion, there's no way I would take a chance going into earnings with a company that is showing such poor relative strength. All right, let's wrap this thing up now, going into the final area. This is going to be upcoming earnings reports this week. And so I don't have those here in this particular chart list, but I will be able to go over those with you. So let's start off with, well, we had one today, Pepsi. So might as well pull up Pepsi. And I'll go ahead and save these in as I go. But Pepsi did come in and report, and you can see the gap up at the open. We went up and tried to get through this 137.50 area, and we reversed, just like everything else in the market. But it's been holding that 20-day, and it seems to be rising. I actually would watch this stock off the 20. I think it could bounce off the 20 and go back up, test the 137.50 level, and maybe break out there. So Pepsi, I still think looks pretty good, but short term, maybe another couple bucks to the downside. Let's move on. Now, that was the only one of significance today. Now, tomorrow, so now we're going to get to look at what should we be thinking about. You know, if I was looking at these charts, would I buy the stock going into earnings? That's the question I'm going to answer for you. So I'm going to look at JP Morgan. First of all, we're in banks. I'm going to tell you that I don't think I want to own any banks going into earnings. Now, it might be a situation where all the bad news is built in and these companies come up with bad reports and they gap up. And if so, that's wonderful. I don't want to take that chance. I think the reports are not going to be good. Banks are wildly underperforming the S&P 500 for a reason, probably for a very good reason. JP Morgan has been underperforming the S&P 500 since back in December, been on this steady decline. Maybe I'm going to be the miracle worker that's all of a sudden going to revive JP Morgan if I own the stock going into earnings. Maybe. I'm not going to take that chance. Now, if there's one bright spot, JP Morgan showing some pretty good relative strength. So if you were going to take a chance with a bank, I would want to be doing it with one of the leaders. I don't think JP Morgan is the leader, but it's one of the leaders. So mixed bag, I would pass on it. Now, one that I think looks a little bit better heading into earnings is Citigroup. Now, Citigroup was down a little bit today, but look at the relative strength here. We were just up at a 52-week high relative to the banks, and it's been trending higher now for the last 3 or 4 months. So maybe this company might have just a little bit of good news. mixed in somewhere. And so perhaps we'll get a pop on Citigroup. Would I buy it? No. Again, I'm just not buying any banks. Just not worth it. Now, let me give you Wells Fargo, which is on the just the opposite end of the spectrum. Wells Fargo right now, well, 2 days ago, was trading pretty close to the May low, which was below the March low. And if you look at the relative strength on Wells Fargo versus the banks, look at this. Now, what's Wall Street telling us? I mean, if Wells Fargo is the big loser on a relative basis and Citigroup is the big winner on a relative basis, I think Wall Street is sending us a signal that based on what, the conversations they've had with management, Citigroup is the better bank to own. Wells Fargo, you don't want it. Now, might Wells Fargo come out with a great report and surprise everyone? Yeah, that happens from time to time. And it might be that it's turning the corner. But am I going to get in and hope that happens? Not a chance. Zero chance. Oh, I didn't add these charts as I was going. I won't have a whole lot of them, so I just want to go ahead and add them as we go. So that's going to be all right, so this will be 301. All right, and then Citigroup, 302. And Wells Fargo, 303. All right, so what's next? Well, another rather large company that will be reporting on Tuesday, tomorrow, and by the way, the ones I've given you so far, they're all before the bell tomorrow. Fastenal. I think we could see a pretty good number here. Fastenal, you can see the relative strength, pretty good. Going across the board here. I'd like to see a little bit more volume, showing more accumulation, but overall, not bad. Yeah, I mean, there's not much negative. I mean, I'm not a big fan of the industrials, but I can tell you that the industrial suppliers are one of only 3 industry groups within industrials that have posted a positive return for the last 6 months. So if you go here and you look back 6 months, you can see we've got a very slight, we're up just slightly here. So, and that's 3, and I think there's 15 industry groups in the industrials. So only 3 out of 15 are higher. So Fastenal, money's been rotating into this stock. Money's been rotating into this industry group. So, of all the industrials out there, I'd give this one a much better shot of coming up with some good numbers. Would I buy this one? Probably not. I think there are others that I'm going to find a lot more attractive. Let's do, how about Delta Airlines? What do you think's going on there? What kind of numbers you think they're going to have when they report? They ought to be really stellar. I think they flew 6 people last week. All right, that was sarcasm. Here was that mid-May to June 8th move. Remember I said that some of these airlines just went crazy? This was at more than a double in 3.5 weeks. Since then, though, we've seen the market, the NASDAQ going crazy to the upside. The S&P did manage to get back up and test that June 8th high, right? Well, look at where Delta is relative to that June 8th high. Do we even need to look at the relative strength chart? I mean, airlines are getting clobbered. So, okay, here we had this big move and we had a little bit of a pop relative to the S&P because we doubled, more than doubled. But look at the overall trend here. Yeah, we had a big move to the upside, but we had a bigger move to the downside on a relative basis during the pandemic. So yeah, we were sold to the downside, got a lot of folks jumping in, and we had the speculators jumping in thinking, okay, this can't get any worse than what it's been. And that black candle right at the top marked the top, and back down we go. Short term, maybe we get a little bit of movement here on Delta, but I mean, it's going to depend on tomorrow morning's earnings. We'll see what happens. I would not be feeling very comfortable holding Delta Airlines into its earnings report. I mean, I just cannot fathom anything positive that's going to come out of that report or out of the conference call until we have some kind of clarity on the virus and, you know, whether or not we're going to have a second wave and so forth. I mean, airlines are just, it's a difficult, very difficult area to invest. All right, let's move on to Wednesday and some of those companies coming up. And let me go ahead and save this first. Oh, I never did save the Fastenal. Okay, so let's move on to Wednesday, and one of the big companies reporting will be United Health. What do we think about United Health? Well, I mean, it did finish up pretty good today. Nice volume increase. I actually like United Health. I think we're going to eventually get this breakout over 310. But does it happen with earnings? I don't know. You can see United Health breaking out relative to the healthcare group, healthcare providers group today. So that was a positive. Versus the S&P, it's been struggling. Why? Because the overall group's been sideways consolidating since the big move up in March and April. But if we get a breakout, if the stock makes the breakout, I mean, it would be even better if the healthcare providers gets the breakout. But I just want to see UNH get a breakout. If it can break out, I would be all in for it. So would I buy this heading into earnings? No. I think there are many other healthcare companies I think that look better in different industry groups in healthcare. I like some of the biotechs much better, like some of the medical equipment companies much better, and probably some of the medical supplies as well. So let's see what comes up out of this with earnings, but I wouldn't be surprised if they come out with good earnings and we get the breakout, but I would still probably sit on the sidelines. I'd sit on my hands on this one. How about ASML? We got a semiconductor reporting before the market opens on Wednesday. What's this look like? I'm thinking pretty good. Now this one, if I was going to want to take a chance heading into an earnings report, this is the type of company that I would do it with. A lot of good strength in this company. What I'd really like to see maybe is another down day tomorrow and get it down near the 20-day and then get it. Hope you get that pop with the earnings on Thursday or on Wednesday morning. Next up, oh, I'm not saving these again. All right, so let's do UNH, save 308. All right, next up is going to be Goldman Sachs. So Goldman Sachs will be reporting on Wednesday. What do we think here? Well, it's doing okay relative to its investment services peers. Not so great versus the S&P 500. Definitely would not be in it. Don't know where it's going. I mean, my guess is probably goes higher, but I wouldn't put my money on it. So I am going to pass on this one. All right, next up, how about the Progressive company? This is a Progressive Corp, PGR. I'm actually seeing equal highs coming across here, rising lows. I'd rather it be off of an uptrend, but that definitely is a triangle formation. A break above 84 is what you definitely want to see here on PGR. Now, will it happen with earnings? Well, we've been downtrending versus the S&P. The group's not been very strong. This has been one of the leaders within its peer group, but the peer group hasn't been very strong. I don't know if it's going to have enough to break out or not. I don't think I would buy this one into earnings. I think I would probably have to hold off and just see, you know, how the earnings come out, and might trade it after earnings at some point, especially if you get the breakout. But right now, I'm going to pass. Let's see, what else do we have? I'm going to move on. I mean, there were some other companies. Actually, I'm going to go with a little bit smaller company on Wednesday, Sleep Number, SNBR. Now, look at this rally that off of the low in early April. and look at the relative strength versus furnishings. Just a huge move up, and look at the volume accompanying that move up. Relative to the S&P, it's now been trending higher for over 3 months. The group, not so great, but this is clearly one of the leaders. It's, again, one of these stocks where if we could get a pullback and get close to that 20-day moving average, I'd feel better about it. Would I hold this one into earnings? You know, if I'm a little bit of an aggressive trader and we get a little bit lower heading into the earnings report, I might take a shot with this one. I like what's going on. I like the fact that it's being accumulated with heavy volume heading into earnings. And I like the fact that it's a leader in its group. So this is one that I could definitely get behind. All right, let's move on to Thursday. So what companies do we have reporting on Thursday? Well, the first one, let's go over J&J. Now, J&J has been downtrending for 2 or 3 months. This isn't just sideways consolidating. This is downtrending. And so relative to the pharmas, it's doing okay, but relative to the S&P, it's not. Pharmas, they looked really good back in March and April. And while some of the other healthcare areas have held up a little bit better, pharmas have really been weak the past 2 months, 2.5 months. And J&J is right in the middle of it, and it's not a great stock relative to its peers. Like I said, continues to downtrend. Let's get back up through at least 150 and then maybe consider it, but I would not be a holder of this stock as we head into earnings. How about Taiwan Semiconductor, TSM? Another one that's moving up. Look at the relative strength, all of a sudden turning up the last 6 weeks, breaking out versus the S&P 500. I like ASML better, but I like this one as well. I think anytime you're breaking out to a new high before your earnings come out, that's normally a pretty good sign. All right. Let me see this one. Next up, and this is the biggie, one of the biggies this week, Netflix. I think Netflix is going to have a blowout quarter. I mean, there's just, I don't know how you can't. I mean, I'm looking at the relative strength, which is now, I mean, there's the internet stocks going up. By the way, it's part of a very strong group, but it is crushing the S&P 500. And even versus internet, it has been one of the leaders over the last 5 or 6 weeks. It consolidated for a bit. I mean, you can see how it went sideways for about 6 weeks. While it consolidated, it underperformed. But once you get that breakout, you tend to start seeing that outperformance kick in again. And that's where we are right now. So I think Netflix, because I said earlier, I think the market could pull back, a little nervous short term. I think Netflix could maybe pull back to that rising 20-day. I wouldn't be shocked, but I'd be a buyer there heading into earnings. This is one that I actually would consider owning into its earnings report. They report Thursday after the bell. So you got 3 more days of trading before they report. Let's see, what else do we have? How about Bank of America? So we looked at some other banks. What's Bank of America looking like? Well, on a relative basis, near 52-week high. So again, I'm not a big fan of holding any of these banks into earnings, but Bank of America, at least on a relative basis, is holding up better than a lot of the others. How about Abbott Labs, back to healthcare, ABT? This stock had a huge run back in April and March, but kind of like Johnson & Johnson, just been drifting. Although it is trying to get through 95. I like this one better than Johnson & Johnson, but relative to the S&P, it's been downtrending now for really the last 2.5 months or so, close to 3 months. So I wouldn't want to own it. I wouldn't take a chance heading into earnings, but like I said, I do like it a little bit better than Johnson & Johnson. All right, next up, how about Morgan Stanley? Morgan Stanley, nice relative strength versus the investment services group. Nice relative strength versus the S&P 500, but it is in a rough group. It's kind of like being in banks. So Morgan Stanley looks really good relative to its peers. So if I had to, like if I was trading a pair, like Morgan Stanley versus say Goldman Sachs, I like Morgan Stanley better based on the way it's looking. But to just flat out go out and buy it, I'd save my capital, my risky capital. Anytime you buy any of these companies heading into earnings, it's got to be risky capital. I don't care how good the chart looks. But yeah, MS, this is one that I would consider. Let's see, next up. How about Domino's Pizza? Talk about a company that has really all of a sudden caught fire here. Oh, it did reverse. I saw it earlier today. It had caught fire earlier, but obviously the fire extinguisher came out. But I still like the breakout here. Volume was picking up, got a nice breakout. Could we pull back maybe into the 390s, maybe even down to that 20-day, which is currently at 382? That's possible, especially if the market's weak. But I definitely would be a buyer at that point. I think this has been one of the stronger stocks. And when you're looking at it relative to restaurants, it's not as good as Chipotle. It's not as good as Wingstop, but it is pretty good, and it is starting to turn back up again relative to its peers. All right, so how about, what else do we have here? Oh, yeah, one I definitely want to talk about, JB Hunt, JBHT. I wrote an article in my Trading Places blog earlier today. Truckers on a relative basis have been really good performers. And remember earlier I mentioned there were 3 industry groups in the industrials that have gone up over the last 6 months. Look at what truckers has done. Look at where we are in second week of July. Look where we were in the second week of January. We are up, I want to say probably about 12, 13% in the last 6 months, which is pretty important because it is killing everything else in the industrial area. So this is the best performing area of industrials. And on Thursday, after the market closes, we're going to get a glimpse into one of the large cap truckers, JB Hunt. And when I look at this chart, I see a stock that's broken out. We could even look at it like on a weekly basis. And you can see we're right up at this 130 level. We hit actually a high that we eclipsed that June 2018 high. PPO looks good, 20-week moving average moving up. I think, if we fail here and pull back, if we get back down below 120, I would think JBHT would look really good. I'm actually expecting a good report on this one. I think we could get that breakout with their earnings. So this is one, again, risky capital. And if I was going to get into an earnings report, because that has the potential of having either a really big move upside, downside, I tend to do it with much smaller positions. If you're wrong, you don't want to devastate your portfolio. So just, keep position size in perspective with these, because your earnings is going to be volatile. I don't care what you own. If you're getting an earnings report, that's new information for the market to digest. And so we're probably going to see a big move one way or the other in many of these stocks. All right, so let's do Friday, which I'm not even sure there really was much on Friday. Let's see. Yeah, we got a couple. Let's take a look here, just a couple of these, and then we'll wrap up. First one up is, let's do BLK. All right, this is in the asset managers group. You can see we're right up against resistance. Actually, you got a nice uptrend, equal highs, rising lows. You got an ascending triangle here. This is a bullish pattern. Asset groups, you can see the asset groups area relative to the S&P 500 has struggled for about the last 5 weeks, but it is off the bottom from back in March, April, and May. So it's maybe not as bad as banks, maybe not quite as bad as investment services, but still not a great group. But this is one of the best stocks within the group, and it is in a bullish pattern. I wouldn't trade it into earnings, but I wouldn't be surprised to see it get the breakout with its earnings report. All right, next up is, Kansas City Southern. Definitely want to talk about this one. So we did just talk about the JB Hunt transports a trucker. Well, if you follow a lot of what I talk about in the market, you realize that when railroads are going to the upside, it normally coincides with really good action in the S&P 500. There's a nice long-term positive correlation between railroads and the S&P 500. So you want leadership from railroads. Well, KSU, when you look at the chart, It was a leader all the way up until March. Now, it did pull back, but that was mostly during this period of consolidation. And then after pulling back, it has started to move back up again. Once again, we're consolidating a little bit, but that could all change with the earnings coming out on Friday morning. So I think this is going to be, this is one of the earnings reports. I would say if I had to rank the earnings reports this week, as far as the ones I'm most interested in, first one's Netflix, no doubt. I just think Netflix is going to be very compelling. I think they're going to have absolutely huge numbers. The second one, I'm going to say probably is going to be Kansas City Southern. I think because it is so influential to many of the other railroad stocks and just railroads in general, and how important railroads are to the market. And I like to pay attention to transportation stocks. Gets really back to the whole Dow theory. When you got transports rolling, setting new highs, that's really bullish for the market. So that's what we want to see. So I'm going to say Kansas City Southern maybe a second to Netflix in terms of, really wanting to see some, I want to see how these earnings come out. All right, let's do one more. I'm going to pick one more. How about, I've done so many financials, I don't want to do another one. How about ALV, AutoLiv? This is a $5.5 billion company. This is in auto parts. You can see the stock obviously beaten up pretty badly in March, rebounded, but it rebounded again. It was one of those weak pandemic stocks that rebounded from mid-May through June 8th and then has struggled, but it hasn't struggled as much as some of the other stocks during this period. So I actually think this one's got a chance maybe to make a push back up towards 70. Would I hold it into earnings? No. I mean, the overall group's not great. We topped back in November from a relative perspective. The stock relative to the S&P for the most part has been going down. I mean, you could argue maybe a little bit of a short-term uptrend off of the bottom at the beginning of April. But, we're nowhere near the 52-week relative high. Relative to its peers, yeah, it was running pretty nicely back here, but we've weakened quite a bit off of that. I just see too many question marks. So ALV would not be a buy for me. I would simply be watching this one as we head into earnings. So those are all the well, not all. I didn't go over all of them, but I went over quite a few of them that we'll be reporting this week. You can kind of take a look, as earnings come out the rest of the week and get a sense of, did some of these pan out the way we thought they might? Were there any big shockers? I mean, we'll have a lot of that to talk about on next Monday's or during next Monday's event. But that's really what I had for tonight. So I don't know, John, if you have anything else, I guess maybe show that special one more time for anybody maybe that came in late. We do have a webinar special that's running. So if you would like to be a part, I mean, if you like what you've seen tonight, you can always sign up for a trial. I'll show you that in just a minute. But here you can see, go in and check out this special. Instead of, after the trial period, if you just sign on as a monthly member, you're going to get charged $97 a month. But we have a special where you can do an annual for $697, which saves you 40% savings, and we'll throw in an extra 1 month bonus. So you'll get the rest of your trial. We're not going to cut off your trial. You'll get your 30-day trial, and then you'll get your annual plus one more bonus month. So you're going to get 14 months for $697. So that's under $50 a month, which is pretty substantial savings off of 97. So anyway, if you like the service, you like what we do here, I would encourage you to first go in and sign up for membership. If you're new to Earnings Beats, you can do that right here on our homepage. This is the page you'll come to. You click on the Join Today, and then you can see some of the things that we offer, and then go in here and click on the Join Today. It's a $7 30-day trial, and we'll refund you the $7. So it's literally 30 days for free. All right. I don't know if you had anything else, John. I don't even know if we have John. All right. Well, that's all I had. So I think we'll go ahead and just wrap it up. Hope everybody enjoyed it. Be back tomorrow. We'll see what the market holds for us tomorrow, but I'll be back tomorrow and over at Stock Charts for Trading Places Live. And then I'll make sure get that DMR out to everybody again tomorrow and let you know what the market's looking like. So everybody have a great night and take care. See you tomorrow. Happy trading.